Are you looking for valuable business advice to reach that 7-figure revenue mark? Do you want actionable tips to properly navigate through every business challenge you encounter along the way? Let Tersh Blissett and Josh Crouch be your guide in getting you to the top here at Service Business Mastery. Tune in as they sit down with world-renowned authors in business, leadership, and personal growth who share valuable insights about management, marketing, pricing, human resources, and so much more. Let their nuggets of wisdom gold guide you in owning a thriving, profitable, and ever-growing business. Here are your hosts, Tersh and Josh.
What is up, everyone out there in Facebook world, podcast world? I hope you're having a wonderful day. As you can see, my cohort Josh is not with us. He's still a little under the weather. For those of you who don't know, he's been sick for a week or two, and it stinks to be sick right around Thanksgiving time, for sure. So if you're the praying type, keep him in your prayers, and keep him in your thoughts, and his whole family and everything. With that being said, I am super excited to have Mark on the show, and we're going to talk about something that's one of our, I know everybody loves this topic, and it's our taxes. And the thing that I love about this episode is the fact that we're going to talk about how we can reduce our taxes and what we have to pay out and everything. Before I get started, though, I wanted to mention yesterday I got this shipped to me, and I wanted mention this because it's something that we do. It's part of our automation process that sometimes I just completely forget that it's done. Part of our wow packages, whenever someone purchases something over a certain dollar amount, I think it's like maybe $5,000 or something like that, a package similar to this gets sent automatically. So Service Titan notifies To Your Success, and then To Your Success sends out a packet of coffee and a cup and everything with our logo and all that good jazz on it. And I don't talk about To Your Success enough. And I think that it's just one of those things that's like, so it's a great product, and the automation part of it. So like when you open it up, they have a bunch of cookies in here. You can set it up for coffee or candies or whatnot. And the thing that I love about it is the fact that it is automated, and so you kind of can set it and forget it within the platform. But I wanted to mention that they're not officially a sponsor, but anytime I need help with anything, To Your Success, the guys at To Your Success, they're amazing, and they're always willing to help us out. But enough with that. I thought it was really cool, and it was top of mind, and I was like, you know what, I need to mention that on the show. But today we're going to talk about taxes, and more so like how to reduce your personal income tax by 30 to 60%, and that's without hiring a new CPA or adjusting your investment strategy, that type of stuff. So I'm super excited to have Mark on the show and learn more about Mark. One thing I will tell you, though, that my introduction says Mark's a former Marine, but we all know that you're never a former Marine. Like once a Marine, always a Marine. Like I'm an airman, and I've, as I got out of the Air Force, it's one of those things where we don't take it quite to heart like a Marine does. But I welcome you to the show, Mark.
Tersh, thank you so much. Thanks for your service. Hoorah. Hoorah. Yeah. We're Semper Fi. We're all in the same on the same team, defending our country together. So thank you so much.
Absolutely, man. So tell me a little bit about Peak Profit Solutions and how you even got into doing what you're doing now.
Yeah, great question. I'll try to keep it as succinct as possible. But, essentially it's interesting. People ask me that question all the time. And, when I tell them my background, they're like, wow, how did you get to where you are now? I mean, my background, I went to University of Florida and got my undergraduate work in exercise physiology, got my master's degree in sports management.
Yeah, so that doesn't sound like taxes.
Right. So like, how did you get to where you are? Well, interestingly enough, when I finished my graduate program, I moved to the big city, Big Apple, and I started working for a club company that was New York only, a really high-end fitness club.
Okay.
called Equinox, and they're in a lot of big cities now. And they only had 11 clubs. So I essentially, at the timing that I had with that company, I ended up moving to Los Angeles and opening up a number of clubs for them in Los Angeles, Hollywood, Huntington Beach, Santa Monica, all these premier locations. And in the process, I essentially became a business operator. I was running the clubs as an owner operator would. So I was responsible for driving revenue. I was responsible for managing expenses. I was responsible for EBITDA margin. And I was actually my incentives were based on margins. So I really became a good operator of a business.
You really need to learn those margins. And like, it's not just, here's my P&L. Like, I need to know that so that I know if I'm getting screwed over or if I'm going to make some money and all that.
That's 100% right, Tersh. So essentially what I realized, after about a decade of running other people's businesses is that, hey, I think there's a lot more opportunity for me to grow financially to run my own. But instead of getting into running, another fitness club and competing with these multi-million-dollar brands, I said, you know what? I talk business owner language. I understand it. So I'm going to be a consultant to business owners. So I initially went out and said, I'm just going to be a specialized insurance producer, high level insurance, buy, sell, premium finance, key man, but not be a securities license. I didn't want to do the whole broker dealer, series 7. So from that point forward, I really just grew. And over time, as I've traversed all these conversations, I started creating relationships with, advanced tax consulting groups, and every single group has a specific area of focus. So I've accumulated over a dozen different relationships over the last decade. And I use those. So I'm a tax architect. I'm not the CPA or the attorney, but I will lead the clientele that I'm working with to the right groups and blend the work together to make sure they have the additional layers of defense that they need.
That's really cool. A lot of people don't even realize that this is even a thing. A lot of people don't think about a tax attorney until they have tax issues, like they're in like bad with IRS or something. They get that dreaded letter like you're getting audited and please provide 7 years worth of history. Right. And you're like, crap, what did I do with last year's taxes? But yeah, like, and then for your role is such an interesting role. You're the connector for this. I guess what, let's run through your process of like, you can use me as an example. Like, hey, Mark, I'm curious how I can reduce my tax burden by, 30 or 60%. Like what do I need to do to get started? Like what's our first steps and how to share that progression along the way?
Yeah, great question, Tersh. Be happy to. So the first questions that I generally ask are, how are you structured? What kind of entity do you have, or do you have an entity? A lot of our clients, might be sole proprietors, but they might also be LLC owners or S Corp owners. Very rarely in the small business world are you going to find a C Corp owner, but they're out there because we work with, our groups work anywhere from small business all the way to like medium size, like really, $100 million companies, or, just a few $100,000 a year. So we're looking at how they're structured because a lot of what we do is legal in its approach. So we're not looking to replace the CPA. We're essentially looking to add that additional layer of defense. And depending on how they're structured, we immediately may see an opportunity to create a new pathway for them to receive a portion of their profits at a lower tax bracket. So we look at structure. And then the next question would be, Tersh, on any given year, what do your revenues look like? What is your net income for the business look like? And how much, approximately how much tax liability do you have? And those 3 things will give us an idea of kind of what directions to go in with regard to the different solutions we can bring to the table.
Is there typically an amount of years in business before your services are warranted? Because even like the question you asked there, what's your typical yearly revenue? Some HVAC companies, when they first start out, they may have, I did 200,000 last year, but my goal for this year is 2 million. And so it's like, what are we going to do? You know what I mean? So is there like, hey, do you have 3 years of trends like that we can look back on or something like that?
Good question. I think the only thing we really need to look for is their current year success,
Mm,
and ideally their confidence that they can repeat that. And it
mhm.
doesn't need to be, oh, well, when you get to $2 million in revenue, give us a call. No, it's more about, are you getting to a point where you're going to be moving $50,000 or more of profit to yourself per year in some way, shape, or form, whether it be part salary and part income above salary. But that's usually the lowest threshold we usually start with, because they're paying, $15,000 or so in taxes.
Mhm.
We start working on how we can, start being more efficient with that. But most of our heavy hitting clients, once they start paying taxes on, 200 plus, so they're hitting that 40, $50,000 mark, sending that check to the IRS, the federal and the state, and
Yeah.
it's like, well, 40,000 to the feds, 10,000 to the state. That doesn't feel too good. Once
Right.
we start getting there, that's when we can really start integrating a lot of different strategies for them.
Okay. Cool deal. Yeah. So that helps out a lot too, because I feel like when we went back when we were smaller, when we were first starting out, most of the times our CPA was like, oh yeah, we figured this stuff out, and like, you don't have to pay any taxes this year. We were able to write it as a loss. And is that kind of the strategy? I mean, you can only depreciate things so much. And sometimes we become successful by mistake. So it's like, yeah, we're at the $3 million mark per year, and it's just because we provide really good service and we happen to have enough demand. Um, it's but we don't really know what we're doing when it comes to taxes. You know what I mean? It's like, uh I don't know how I did this. I got it here by mistake. And I hope that I'm not screwing myself up. Like, does that make sense?
Absolutely. It does. It does. So very much so. And I can give you some examples of experiences that I've had working with business owners just like that. So
Yeah, share a couple of those examples, because that's where I feel like a lot of our audiences, and I've even been there myself, where it's like you come into the CPA's office. I mean, hopefully you're doing this conversation quarterly, but sometimes it's yearly, and sometimes you filed the extension and it's October and your first time walking into the CPA's office. I've
so
been
very
that guy
true.
before,
Yeah.
so
Sounds like you got some experience in that.
I have done that once, maybe twice. And so it's like, yeah, but like, you should have done this stuff in January and like all year long. It's October now, so you're screwed. So yeah, share some stories that you have there.
Absolutely. And I would say that, at least 50% of the time when we're working with a small business owner that's built their business on their back, they've worked very hard, they provide a great service. And of course, when they provide a great service, people come, as you know,
Mhm.
and all of a sudden they got a tax problem. They didn't, and it just snuck up on them.
Mhm.
So that is generally, when we're dealing with that situation, they're likely not doing quarterly meetings with their CPA. And even if they were, their CPA probably has a lot of clients and they don't have the bandwidth to do a lot of forward planning. They
Yeah.
do as much as they know to do, but they're not really saying, hey, we need to look at these additional solutions and integrate those in. They're usually going to be saying, hey, what other expenses do you have? Oh, we can take that. Do you need to buy any equipment? Right? Because we get section 179, that kind
Right.
of thing.
Yeah.
So it's more
Yeah.
like spend $1 to save 35 cents. So
Yeah.
we
But
take
it's also like, hey, go buy a new truck with what cash? Like,
right, right. Where
oh,
am I
wait a minute. Oh, so you have a cash flow problem too? Let's revisit that also. Like,
That's right. That's right. So when that happens, I mean, essentially, it's kind of a nice conversation because we can say, Mr. or Mrs. Business Owner, right now, all of this, the way you're structured, your profit that flows to you from your business is kind of like a waterfall. Whatever you don't buy and expense out to business expenses and then maybe defer in a qualified account. It's a whole nother conversation, which we don't have. We don't take over the advisor's role. We actually give them more money to work with. So that's why a lot of advisors like us. It just waterfalls down and hits that 1040. So you think about that punch right between the eyes. It's like, okay, here's your profit and here's the federal tax bill. And if you're in a lovely state that has the state tax on top of it, you're going to have that as well. So, and it's retail. I always say that's a retail tax bill. So what we do is say, Tersh, hey, let's look at the wholesale pathways, because you may or may not know this, but 55 of the top Fortune 500 companies last year, like Duke Energy, Nike, to name a few. They had billions of dollars of profit or hundreds of millions of dollars worth of profit. They paid zero federal income tax. Instead, they got rebates. So how are these 55 companies navigating that much profit and paying zero federal income tax? Well, they know some things that we don't know,
Yeah.
and they have high level legal planning. So a lot of the groups that I work with, one in particularly, has 40 years of experience at Deloitte. And 15
Wow.
years ago, they said, we're going to take this knowledge and experience and we're going to help that 9.5 million small to medium sized business owners out there. They don't realize that they could create a new pathway. They could have another entity that essentially earns money from their main entity, but that entity is created simply for their family, and their family can take a whole bunch of benefits out of it that are essentially much more tax efficient, some of them tax free, than actually utilizing them in their main business. And sometimes they can't even utilize them in their main business because they're not legally structured the right way. So we're always looking for new paths to move their profit to themselves.
So you're saying individual would even create another business entity separate from the actual business itself?
100%.
Okay. All right. And so what about like hiring kids, our children, to do certain jobs? Now, can that be done within the business, or would that have to be done within the second entity, or that
You
kind
can
of muddies it a little bit, I think, maybe?
Yeah, it's a good question. And generally speaking, when you're starting to look at the fringe benefits, because there's
Yeah,
about
yeah, yeah.
20 different ways in the tax code, and they've been there forever.
Right,
Now,
right.
you can essentially take benefits from the company and deem them not taxable because they're not profit or income or
Yeah,
salary.
yeah.
It's just some of that is paying kids. Some of it's like, hey, we can actually reimburse college tuition, all these different things. Any dollar amount over your HSA, like if you have out-of-pocket medical expenses, those could be tax deductible over, things that you generally have limits on.
Mm-hmm.
They all go away. So it's really, case by case. But at the end of the day, we don't usually recommend putting all those policies in the main entity, because when you start putting those policies in there, you have to offer them to everyone in your company.
Oh, yeah. That's the
So
point. Yeah.
when we carve it out and say, hey, we're just going to have a service company, like a consulting based company or management company, which is totally fine. And a lot of these policies are going to be written in. So they're really just for the benefit of the family
Mm-hmm.
and whoever they want to add into that company. So it really becomes more of an exclusive. And this is what owners of large companies have done for decades. They have
Yeah. Oh,
their
yeah.
marketing and management company, and it peels out, $100 to
See, I've heard
$200,000
of
a year.
people, I know personally, I know people who have these other entities for the license aspect of things, but we've never had the conversation of the tax ramifications that come along with that, because like in certain states, you like like if let's say I'm in a state where I have to be the license holder, or the business owner has to be a license holder in order to bring on a new trade like plumbing, but I don't have the license, so I want to bring somebody in. I've heard of people taking and having another entity that that person is a partial owner in that entity, so they don't bring them in as an owner of your big corporation that you've been building up, in case there's any kind of needing to separate in the future. But I haven't heard the conversation of specifically about the taxes. And I feel like, and correct me if I'm wrong, it's just what I'm just spitballing here, but I feel like it may add another layer of protection or security when it comes to tax auditing. Is that an accurate statement?
Absolutely, because now you're looking at your P&L as an aggregate, and you're not looking at profit from just one business. You're looking at profit from multiple businesses. And the idea behind the other businesses are that they're going to be net zero companies,
Yeah.
because the whole idea is that they are doing and providing a service to the main entity that is legitimate and has economic substance. So there actually is work being done, but the idea is that you're able to extract the profits from those entities, because there can be more than one depending
Mhm.
on what they need to do, at a much lower tax bracket, some being tax-free fringe benefits. And if we want to get into like a little bit bigger cases, we're looking at what the bigger companies do, which is profit relocation. So a lot of bigger companies, Why is Apple in Ireland? Well, it's not because they want to hire Irish citizens, right?
So
Why
there's a
is
tax benefit to be there to
yeah,
open up business there. Okay.
exactly. All the big companies have
But
divisions of their company in
would
more
you
tax
have
efficient areas.
probably not a small business like a mom and pop HVAC company? You probably wouldn't get into even if you were in the $20 million range.
Yeah, it's interesting. We have one of the groups I work with, which is the predominant group. They have the ability to turnkey the profit relocation scenario, and essentially they're duplicating what the large companies do. And
Okay.
the reason why they do that is because they actually help the large companies do it when they work with Deloitte in their first 25 years of business. So they know exactly how to do it. They just said the smaller company just doesn't have the bandwidth. They don't
Oh yeah.
have, to go get the grants and set up shop, and basically what is the company going to do, and then how do we manage it, and then of course the other side is, well, how do we access those profits at that lower tax bracket? So they turnkey it. So it's almost like we've had companies that shift as little as $150,000-$200,000 of their profit. So obviously you need to have $400,000 or $500,000 of profit to start thinking about that
Yeah.
solution.
Yeah.
But for as little as that, we can start saying, hey, you don't have to do all of the work that your company is currently doing in your current main entity. We can carve out some of the work that you're doing, do it better, do it more efficiently, because that's the key. It has to have value.
Hmm.
And the cool thing is that other group, that's that other division that's doing the same, doing work that you were doing in-house, what's being done in an economic development zone, and they have the right to earn profit. So let's just say you're paying bills, and those bills, when you generally pay them from your main company, and you're paying out, say, $1 million a year in vendors, right? Vendor costs
Yeah.
and expenses.
Hmm.
Well, paying from your main company in Georgia was just an expense. Have a procurement company in an economic development zone, the same expense goes out, but that procurement company can charge an invoice for doing the work. So now you're pulling profit from your Georgia company
Oh
to your
yeah.
economic development zone, and now you want the profit to be earned in the economic development zone because maybe there's a 4% corporate tax, and maybe you
Okay.
can take the
Yeah.
rest of the tax exempt dividend. So that's where
Yeah.
it's like you're starting to do what big companies do, but you're working with a company that can just plug you in. It's like,
Yeah.
we have the whole setup. How big of a space do you need?
Right. Yeah. I mean, and that's the thing that whenever I think I know when I talk to business owners, the conversation that will have is like, how do you how are this person making money and they're showing losses and, or they're showing profits, but they're not, getting killed. And then when you even dabble into any of the conversation, a lot of times it's like, okay, but then are we penalized when we actually take the money out of that company? Y- are we robbing Peter to pay Paul, essentially, and to create more busy work for ourselves?
And that is the key. A lot of times when we're doing analysis work for businesses that have started to get a little bit more sophisticated, it's like they have 5 or 6 entities. And you're like, why do you have this entity? Why do you have, well, this is a leasing company. This is why, but the net result still flows to you at a retail tax rate. So maybe you have a little bit more asset protection because maybe your leasing company is an LLC and this, but there's no real tax benefit. So we're always looking at, everybody has their KBIs and their key performance indicators and their profit centers. Hardly any small business owner, because the big businesses do this,
Yeah.
but small businesses, one of the profit centers for big businesses is their tax bill. That's a profit center, because if they
Right.
can
And
reduce
people are like, we think this is a dreadful time. And they're like, let's make some money off this.
exactly. So we basically, what I like to do is say, hey, we can bring that big company approach to a smaller company and turnkey it, and not say, hey, you have to walk away from the CPA that you know and love.
Hmm.
We're just adding these additional layers in. And as the company grows, we can actually add more layers in. But at the end of the day, going back to your question, is we're not looking to create entities that are just moving the ball around. We want to make sure that this entity is earning more of the profit over here, because we can take some of it as tax-free fringe benefits at zero tax. Maybe it's earning it over here because it's in an economic development zone, and we can take it at a lot lower corporate tax plus some tax exempt dividends. I mean, we could even get trust scenarios involved as well, where you can have a part of your company be owned by a trust, and that trust can give the business owner significant advantages as well. So it's a lot of
So
things that can be done.
tell me this, what happens? I've got like 1,000 questions that keep popping in my brain, but the last thing that you mentioned there, especially with the trust and everything like that, what happens whenever we have a business acquisition scenario? Like, do you run into that very often? And is it like, all right, here's our 5 accounts, here's our 10 different, things, but you're only purchasing the main corporation, or you're purchasing all of this, or do you ever see a scenario where they're like, you have 6 different, entities? Like, that's shady. I'm not buying your business, or that's too confusing. I don't want to purchase your business. Have you ever seen that type of scenario?
Great question. And I actually have that question sometimes with business owners that we're working with that are saying, hey, we've been doing this for a while and we're not ready to stop yet, but we're probably going to be looking to sell in
Yeah.
3-4 years, maybe 5
Yeah.
years. How's it going to work with these different divisions? One is obviously for our family.
Yeah.
So it's an easy conversation, Tersh. We say these divisions can be shut down just as fast as they can be set up.
Okay, cool.
Because what the acquirer is really buying is your base company.
Gotcha.
But you're showing them an aggregate. You're saying, hey, here's where all our profits going. And a lot of times they say, well, we want to keep that. We want to keep that division going. Like, let's keep that going because the tax benefits move to the new owner. But they don't have to. Let's just say they don't like it. They're like, I just want to, I'm black and white. I mean, not that this is not black and white. This is, it is tax code stuff, but they're just like, I just like paying retail. I don't want to do anything outside of, what I know. And so, but I will say this last thing on that, Church, is that becomes a whole nother conversation, because a lot of people, a lot of business owners don't realize that they can legally eliminate or defer, depending on the situation, the capital gains tax that they have to pay when they sell their business. And I always get that.
That's a question that, like, we've had several business brokers on the show, and they're like, it's very important the way it's worded when you sell your business or when you're purchasing a business because of capital gains tax. Like, not as much the purchasing aspect. Well, it's the seller doesn't want all of this stuff. But yeah, keep going. I didn't mean to interrupt you there.
No, you're hitting the nail on the head. I mean, essentially, I'll get 2 scenarios. A business owner that's like, hey, I heard you're really good at tax efficiency, and I have a big tax bill. And I'm like, great, tell me about it. They're like, I sold my business about 6 months ago, and I'm going to have to pay taxes on, $1 million or whatever. I've seen more. Some of them say $20 million, but some of them say, a few $100,000. It doesn't matter. They still have to pay capital gains tax, which is generally going to be at the lowest amount, 23.8%.
Exactly.
But in other states like California, 35. So that's a big chunk of change for something you sold that you worked your whole life on or a long time to build. And that's when I'm like, well, I can help. But I could have helped you a lot more if you told me before you sold, because it's assignment of income. It's essentially saying, hey, when you're structuring that sell, the seller doesn't really care who they're paying as long as they acquire the business wholly.
Yeah.
But if the income is assigned to you, Mr. Business Owner, then the tax bill is due as soon as that payment is made. But if you can assign or convey, and it doesn't even have to be all of it, it can be a portion of the sale into another environment where it's controlled. Like, you might not own that environment, say it's a trust, but you control it fully. Well, there's no taxes due. So essentially you can bifurcate the tax bill, either 100% or a portion of it, by simply assigning or conveying a portion of your interest of the business into another environment prior to the sale. And now you can actually put that money to work, right?
Yeah.
Instead of saying, well, 30% went to the government, now I can put it to work. No, I got almost all of it and I can put it to work.
Or you sold and you're like, all right, so the way my calculations work here, I need about $500,000 to live out the rest of my life.
Right.
And you're like, okay, so when I sell the business, I'm going to make $500,000. Oh, guess what? 23% of it's going to taxes. Oh, so I'm short 23% of my 500. Now I got to get another job. Like,
100%. We can basically take that 500 and say, guess what? Let's put it over here first. Let's put the assignment of your asset in here first, which you can fully control. So now the 500 makes it in here. And then you can start reinvesting and earning interest without gains. And then depending on the structure, it may be that you're just paying taxes as you take money out in little pieces.
Yeah.
Or it could be, some structures are efficient in almost eliminating tax, but that's a whole nother more complex conversation.
So one of the things that you mentioned early on, and I didn't want to go back to it because I know we can get into a rabbit hole with this conversation, but I really want the audience to catch it and really just gnaw on this for a hot minute. And that's the fact that you mentioned in the conversation about visiting your CPA quarterly, and you even mentioned that a lot of CPAs can kind of be stretched thin, and they're at their limit of being able to offer additional services. I'm guilty of it. Now I have a CPA that's 300 miles away from me, but I've been the person who was like, "Hey mom, who did you use? Who's your CPA?" Like, "Oh, it's Sally down the street. She does our, and she gets online and does her taxes once a year." And so like I've used Sally because she was right down the street and she was cheap and would do my taxes once a year. But a CPA, in the grand scheme of things, shouldn't cost you money. They should make you money, and you should be meeting, and they should be proactive instead of reactive. And you mentioned them being at their, like, just getting their taxes and even meeting quarterly. They just have enough bandwidth to react to what you've already done, and hopefully you didn't wait a year, almost 2 years, because you waited until October of the previous
Right.
year's taxes stuff. And so I would preface that with like, "Hey, look, somebody might say, yeah, it's going to be $2,000 to use this CPA or whatever." I mean, you might be used to paying a couple $100, and then someone says it's $2,000, but that CPA may actually be someone who's proactive, and they may make you an additional $10,000. So just keep that in the back of your mind whenever you're thinking about this entire situation, as far as if you're getting to that point to where numbers are getting big, or bigger than where you're comfortable, and you're like, "Okay, I need to hire a CPA." I will tell you that it's probably been 2 years ago now, maybe even 3 years ago. I had a guest on the show, and something he mentioned that really stuck with me is having your 5 people. And we all know that we are the 5 people that we surround ourselves with. But one of the things that he mentioned was, have a good banker that's your first name basis with, have a CPA, it's the same, have a tax lawyer and an investment advisor that does the same exact thing, and then a mentor. So like, that's just something that really, really stuck with me. And I'm not even like, I don't have an amazing tax lawyer or anything like that I'm really good friends with. If anybody's listening to this and you're a tax lawyer, hit me up. But I'm it's just something that really resonates with me. And like, it's do as I say, not as I do type scenario. But I can speak from experience. Like, you don't want to be calling out to tax lawyers. You don't want to be calling out to a CPA when you're in trouble, with the IRS type stuff. And it's the same with Mark here. Like, I'm loving this conversation because it's very proactive work versus reactive work. And a lot of times we stay so busy in our businesses because we're putting out fires. That's what everybody says. Like, I can't do X, Y, and Z because I'm just busy putting out fires all day long. Well, if you're proactive in your taxes and all of this investment and stuff, you're less likely to have to spend the time putting out fires, because you're being proactive in this situation. And so I super appreciate you coming on the show, Mark, and sharing all this information with. Before we go though, I'd be remiss if I didn't ask, because it's something that I know I'm thinking and everybody else is thinking. With me mentioning with the CPA and the cost difference, what typically is an investment? And I know that it's going to range, because you can't charge a $200,000 company the same as you charge a $200 million company. But what's a typical investment in this process and getting the ball started and stuff?
Yeah, absolutely. Well, the good news is the first step is a complimentary consultation. I only need 20 minutes of someone's time to determine what pathways are readily available. And depending on those pathways, there might be a small retainer to get the work done initially, to get the analysis work done. And we're talking like a few $100s, maybe,
Oh, yeah.
depending if it's a lot of analysis work, maybe, $1,000, $1,500, not a big deal.
Yeah.
But the good news is we're not going to do the analysis work. I'm not going to even allow for the analysis work to happen unless I know proactively based on the information the conversation I've had and the facts that I've found from the complementary analysis, that we're going to save them, depending on the size of the business, 30, 40, 50% of their current tax bill. So we always look at it in percentages. And I'm thinking, when I'm talking to a business owner, I'm saying, there's likely a 20% reduction. We could have 30%. So if they're paying, easy math, if they're paying $100,000 in tax, I mean, obviously not everybody's paying that. Let's say they're paying 10,000 in tax, but I'm looking at, hey, we could probably carve 30% off of that. So if that's 3,000, or if they're paying 50,000 and it's 9 or 12,000 or whatever it is, well, if they know that they can do some analysis work for a few $100 and then maybe engage with us for a couple of $1,000, and all of a sudden they're saving 3 times more in the same year. So we're talking about a ROI in the very first year. So I always go back to investments. Well, when you gave your investment advisor that, $1,000 and you're like, I hope it can give me 6%, but you might lose all your money too. I'm saying, well, this is pretty much a guarantee. We're using tax law to take that dollar that you're using for us to help you structure better, and we're going to give you back 5 from tax savings.
Once the relationship has been initiated, is it typically like you can typically figure it out within that first year, or is this something that you need to do an analysis every year on?
Most of the strategies that we put in place, when I say we, it's the core group of tax, because we tax attorneys, CPAs, et cetera. They're evergreen. So once the structures are in place, it's like, hey, you continue to use this for as long as you're in business. And now, of course, if tax law changes, well, because it does, it's a moving, it's like the fairway might shift a little bit, and you don't want to be in the rough. You want to be in the fairway. So that's why we have, like, most of our groups I work with have retainer packages where they can stay on, or you can just go back with them every year or so and say, hey, just want you to reevaluate what you put in place for us a year or two ago. If anything's changed, let us know. And they essentially shore them up. So there's always an ongoing opportunity to stay engaged, because again, CPAs are they don't have the bandwidth to know what the latest court cases specific to this tax code that's in 70,000 pages that maybe not everybody even knows about to begin with, So
tell me this, what happens if you get into analyzing our situation and you're like, hey man, look, I'm just going to be blunt with you. Your current CPA is garbage. So I recommend this person here. Like, do you have that ability? Like, or if I come to you and say, hey, look, I don't have, there's no love relationship with this CPA. Sally, she's just Sally. Like, I don't really care. If I need somebody else, can you recommend someone to me?
Yeah. And here's the thing, and I want to make sure this is really important to communicate. The goal for what I do and what the groups that I work with do is not to put the current professional on notice.
On blast.
That's right. It's more to just evaluate what's currently being done and provide additional layers of efficiency and integrate. So, there's going to be times that we might see that the CPA was really asleep at the wheel. But that's not that, normally it's not, because we're really doing things that most CPAs really don't have the licensing to do. They're not attorneys. So, but I'd say every once in a while we'll have the CPA. But here's what normally we run into is, only 2 or 3 out of the 10 CPAs out there are forward thinking and know that there's more things they can do that are outside of their scope. The other 7 or 8 or 9, sometimes it's 9 out, 9, 1 out of 10. They're like, well, if I don't know about it and I don't understand it, I don't like it.
Exactly.
And now the business owner has got to make a decision. And that's when I say to the business owner, hey, it's your decision. You're the business owner. But I can tell you, I've got dozens of accounting groups and CPAs, because we work in all 50 states and we've been doing this for 16 years for small business. I would love to have your business that already have clients that are doing this.
Yeah. So, and that's something like even within our peer-to-peer coaching groups, there's certain people, like people, I'll hear them say, like, my CPA would not allow me to do that. Like, my CPA wouldn't let me, write off a van wrap as marketing expenses. It's like they would just say, like, well, my CPA won't let me do this because it's not, like, that's not how they've ever done it before. And like, if it's not that way, they refuse to do it. And it's like, are you working for them? They work for you. Like, how's this relationship work again?
That's right. Well, I look at too, Tersh, this is one of the things, the analogies I use is, hey, if you were to look at your primary care medical physician as the end all be all, you probably would run into some problems down the road, because
Yeah.
you might need some neurology assistance. You might need some ear, nose, and throat assistance. And God forbid you need oncology assistance, or,
Yeah.
there's specialties, right? So CPAs, I think, are good general practitioners, but the reason why they have never really been apt to refer to specialists, because most of the specialists say you don't need your CPA anymore. Come with us. So
Mm.
now what we do is say we will be the specialist that doesn't take business away from your CPA, unless,
Yeah.
of course, they're being hard-headed,
Yeah. Refuse to
or
doing it.
you realize that they're not valued to you, and then we say, hey, we're not going to become your CPA, but we have dozens of CPAs we can refer you to. Why don't you interview these two? They already know us. They already have clients that work with us. Maybe you'll like one of them. So that's
Yeah.
kind of how we roll.
Sweet. And website, best place to get in touch with you.
Peak Profit Solutions. So Peak Profit Solutions, that's solutions with a S at the end. Peakprofitsolutions.com. You'll have my ugly mug on it, a little bit about me, some ways to schedule a complimentary consultation if you want it.
Mark, man, I appreciate it. I've gotten tons of knowledge out of this, and even thought about things that I've forgotten about in the past that I need to rekindle relationships with people. So huge shout out to you. And I really appreciate you spending some time with us today.
Thank you so much. This has been my pleasure, Tersh. Thanks so much for hosting such a good show.
Absolutely. If anybody has any questions, please do not hesitate to reach out to Mark. This is one of those things that I really believe that's going to be a massive value for you. If you have any questions for me, as always, don't hesitate to reach out to me as well. With that being said, I hope you have a wonderful and safe week until we talk again next time on Service Business Mastery Podcast. It's a podcast focused on service business owners, managers, and technicians who are considering becoming business owners themselves. Until we talk again next week, be safe.
Thank you for listening to this episode of Service Business Mastery. Now that you are equipped with essential business advice from this impactful conversation, you are one step closer to becoming the successful owner of your dreams. If this episode has been helpful to your business journey, don't forget to subscribe to the show, leave a rating, and share it with other owners as well. Visit servicebusinessmastery.com to learn more.